Q3 has come to an end, September has come to an end, and according to our seasonality experts, get ready to rejoice in the best trading time of the year. And don't get me wrong, I'd love to see that work out, but do the underlying data points actually support that claim? That's what we'll look to explore in today's episode of the Weekly Watchlist. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY monthly time frame chart, what do we see from a candle structure and location point of view? Certainly a solid red-bodied bar, and you can see a little bit of a lower wick. Nothing to read into from a psychological perspective, so the sellers did a great job of closing extremely weak at the bottom of the overall range. So check mark goes to the sellers on the location front. Clearly a bar-to-bar lower high as well as a lower low. So 2 for 2 on the selling front, and yes, we did actually close underneath the previous monthly low as well, adding a little bit more strength to the seller's argument at this point in time. And I'll be the first one to raise my hand and say, sure, we took the hammer candle at face value last month, and I will stand by that analysis 10 out of 10 times. If we were to have taken out the top, it would have changed the story, and you would have been saying, yeah, of course the lower wick represented a pullback, right? So at face value, closing underneath with a lower low and a lower high is now definitively bearish on the monthly time frame chart, at least on the bar-to-bar count. In terms of the overall trend sequence, is it not still valid that we could go low, higher low, and there's still the opportunity for a monthly higher low somewhere around the magic number of 416.50. We'll see it on the daily time frame chart in just a moment, but a retest of the inverted monthly head and shoulders here could provide a break, retest, and the potential, as we just pointed out, for some sort of monthly higher low. We do have to contend with the fact that this may start to become a monthly lower high, but it would only become a lower high double top if we start trading around the neckline of that as an overall pattern, which is much closer to 360. Could I foresee an October bar looking something like this? The odds would tend to say no, the market can always do whatever it wants to do, but the odds, the probabilities would suggest no, that's not a likely look for the October time frame. Let's take a look at some Fibonacci perspectives here on the monthly time frame chart. Just to remind you, if we come in from the low of the sickness move to the high, we're still well above the 38.2, and on the monthly time frame chart, even with the pullback that's unfolded in the month of September, it doesn't feel much more than anything other than a monthly bull flag that has broken out to a higher high from this sequence at least. This is more so the weekly sequence, right? But nonetheless, broken out to a high from this perspective, pulling back. If we get a retest in here, seems very reasonable that the monthly could offer something that looks like that. And once again, we will be the first ones to change our tone when and if we break that level, but we just haven't done it yet. Let's take a look at the weekly time frame chart, speaking of the smaller time frames, and walk through our typical analysis on this level. So on the weekly chart, candle structure is definitively more neutral just because we have more so of a hammer candle. It's not a perfect hammer. We do have a little bit more upper wick than what we'd prefer to see. It's a red-bodied bar, so the sellers did do a great job of closing underneath the opening print, but there was at least some buy-side pressure we need to acknowledge off of the lows of last week's trading session. Unfortunately, on the bar-to-bar count, we did continue to produce a lower high as well as a lower low. If you tuned into the Wednesday update video, we said keep an eye out to see whether or not we could have turned this into a green hammer candle. Obviously, that is not the case, so I'm not as keen about a counter trend rally unfolding here on the weekly time frame. Could it still unfold? Yes, but the odds are not as strong now with the lack of a weekly close back inside of the breakdown bar at this point. From the weekly trend perspective, we know that we're certainly in a weekly downtrend, right? Because we have highs, lows, and certainly a big time lower low. So even if we do rally to produce a counter trend move, it is not going to change the weekly trend to a new uptrend. And the primary idea on the weekly is to produce some sort of weekly lower high underneath the double inside bar consolidation range before we broke on down to produce the new lower low. On the daily time frame chart, we'll see that number as being much closer to 443. I believe it's 75.25. We'll get to it in just a moment, but nonetheless, that's the general area that we're looking for. What else can we say here on the weekly time frame chart? Now that we're in a weekly downtrend, once again, the monthly target is back down here, closer to 416s. we're getting close, and we also have a weekly 50 SMA that could greet us there. The lower wick is starting to imply that maybe buyers are going to step up early, but once again, with the lack of closure inside of the previous weekly range, I wouldn't be overly aggressive on forcing a counter trend upside move into the upcoming week's worth of trade. Let's take a look at the AI Mania VWAP here, so bringing out our weekly VWAPs for the S&P, and what you'll notice is that we are firmly underneath it still, even after this hammer, even after a little bit of the counter trend into the end of the week, Thursday primarily, right? We did recapture this, so I would not firmly consider this VWAP resolved yet, but we didn't hold on to it perfectly, so to speak. The other thing that we have not held on to perfectly here is the Fibonacci sequence that we've been discussing. If we come from here down to the low, and if we come from here up to the high, remember that we have this massive confluence around roughly 430 on the S&P, and we've closed right at it. The anchored VWAP is right at it as well. So I wouldn't call this firmly resolved, but the fact that we're kind of struggling around that area at least leaves the door open to the potential for a counter trend rally. We still have to contend with this anchored VWAP as resistance from the most recent high, and the AI Mania backtest anchored VWAP as resistance on the move potentially higher. Once again, both of those things are roughly in alignment with the retest of the bottom of the 2-week double inside bar range that we were just referring to around 443.25.75. We'll see it on the daily in just a moment. Last thing to point out on the weekly perspective is, of course, the volume profile. If we take a look from this perspective, here is the low volume void that we find ourselves within as of right now, and the market is typically attracted to high volume nodes. So either we're going to come in for a back test of the bottom, once again, of the double inside bar range, that's the high volume node to the upside at this point in time, or we will be drawn lower towards the monthly retest level, which we were just referring to at 416, again, 25.75. We'll see it on the daily in just a moment, but that area down here as your next high volume node, being caught in the middle, is usually an uncomfortable place for the market to be. The last thing I would point out here from the weekly time frame perspective before we move to the daily is just that the upper wick of this week's bar is almost a perfect retest of the neckline, if you want to consider this a double top, right? And also our prior soft lows over here. So once again, if this were a green-bodied hammer candle, a little bit more confident in a stronger counter trend move, but as of right now, with the upper wick rejecting this structure as well, I would tend to be more neutral to bearish edge down here. Maybe there's a counter trend, but primarily leaning on the more bearish outcomes as we move forward. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. For the most part, if we're contained by the upper bound, the number is 435.60, give or take, and that, of course, would still imply a big-time lower high. If we're contained by the lower bound, the number is 419.40 roughly, and that's still going to produce likely some sort of lower low, so expected move here is undoubtedly bearish. If we take a look at the overall trend, it doesn't take a rocket scientist to see, of course, that we, of course, are in a downtrend at this point in time, and there's the potential that Friday's failed gap up did just set the next daily lower high. But also remember, on the daily time frame chart from a pattern perspective, this also is a double top breakdown, and as long as we produce a daily lower high anywhere underneath 443.25, which is also the backtest of the double inside bar range on the weekly time frame chart, we have both a weekly lower high and a daily lower high that would sort of carry on there. So not thrilled about the opportunity for a daily trend reversal yet. Nothing about this chart would suggest that there is likely going to be a flip to an uptrend anytime soon, especially with a brand new lower low being brought in on the Wednesday move lower in the morning session there. If we take a look at the pattern, specifically Friday's failed gap up, that would tell me a couple of things. Remember that a counter trend move did start on the Thursday session. If I zoom in a little bit further on this, we started up and over the hammer high from Wednesday. That breakout level was 428. The fact that we gapped up and over that level, there was no gap fill reversal, and we closed underneath the 428 level would tell me that really new money buyers are not all that interested in buying up this market at this point in time. If we take a look at some Fibonacci's on the daily time frame chart coming from this all the way down to the bottom, notice that we are still underneath the 38.2. If this is going to produce bear flag consolidation, ideally the bears keep price underneath 433.65, and as you can see, that would have been your 38.2. Friday's lower high potentially is that threat as of right now. If we take a look at some trend line analysis, let's bring this back out to this look over here. Just a reminder that we're sitting on the October low trend line, and if this breaks its confluence with this as a pullback channel from something like the monthly perspective, right? This is a pullback in the monthly perspective, but overall this confluence, it's threatening a break. If that does break, the implied move from a head and shoulders from this perspective on the daily or even weekly at this point in time would sort of bring in lower prices towards 411. That would be a big breakdown of your 200 SMA, excuse me, that's the green moving average. We haven't talked about it in so long I almost forgot. That's a major breakdown, right? And it would also bring us back to the midpoint of the GFR, God-forsaken range. Remember that was just an awful month and a half worth of balance before finally breaking out on the AI mania news. The last thing I can sort of point out here is if we throw on some studies as the anchored VWAP cluster from all the major pivots on the time frame here, this once again is suggesting that, okay, the AI mania buyers of everything after the break from in here, not feeling so great, but the longer term buyers involved on the October low, the pivot high from here, 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 and here, they're still doing okay as we stay on top of the anchored VWAP band. Once again, breaking down underneath the support trend line in both senses, the October low and the counter trend here, right, would suggest that the lowest bound of the lower anchored VWAP band is confluence right now with the expected move or measured move from the head and shoulders 411. The last thing, let's actually move along to the hourly chart. Sorry, it's like one last thing after the next last thing. Here's the hourly time frame chart. What do we see over here? Lastly, now I can say that, you can see that this as a balance area has not held up. Here's the break on the Thursday session. There's the attempted higher low into the afternoon. Friday is a thing of beauty, right? It's a gift to the buyers because any buyers who got involved on this move in the Thursday afternoon session are made whole. They're actually quite happy about the gap up on the Friday session. Their positions are looking fairly good. And as we start to potentially threaten these short locations, it's not looking good for the shorts. The fact that we do not hold the gap fill reversal, but it goes further than that, the fact that we break down into the afternoon underneath the breakout point and the low of the consolidation from Thursday does a couple of things. Number one, anybody who tried to buy the consolidation in here is now underwater. Number two, if we were looking at an hourly counter trend move with lows, higher lows along the way, higher highs and higher highs on the gap up, this of course just violated your last higher low, and now we have a lower low. So from an hourly trend perspective, really not looking all that great here for some sort of continuation of the counter trend move towards this overhead gap, which could still very likely produce some sort of daily lower high. So what does that leave us with from a path perspective? Let's quickly throw on the anchored VWAPs here from the intraday breakouts. I think it's very clear. I think that we probably want to maintain more of a bearish edge if we're underneath 428, and we want to start thinking about Friday's gap up high as the daily lower high to continue the overall trend sequence in the downward direction. So in here, bearish consolidation looking for breaks of 425. You'll look for the low of Wednesday's session, but ultimately we want to start looking for 420.50 in the lower bound of this week's expected move. Again, consolidation here is bearish consolidation, break lower high, looking for lower. We're underneath the entirety of the anchored VWAP band. Things get a little bit more confusing if we can trade over 428. I'd be very neutral in here. I would get rid of the bearish edge on the neutrality. And then obviously the buyers want to see a break to higher low over 430 for the potential of low, higher low. Maybe on the daily time frame chart, this starts to serve as the initial higher low, but it's really, again, still a counter trend move, very much so in the context of a well-established now downtrend, right? So higher low over 430, we can start to look for some of these upside targets, but I still would not be overstaying my welcome as we approach 433.65, and then into this week, maybe we start to interact with the gap overhead. That's 436 and 438.50 is the closure. Remember that if we start to interact with this, and the weekly expected move would suggest that staying contained within, there's the possibility for your daily lower high to be set here. I think that maybe it's already on the table with Friday's breakdown, and as we discussed, the acceptance underneath that 428, but once again, this is still a viable outcome. We're trading scalps in the upward direction here for, once again, a counter trend move. I can't emphasize that enough right now because the weekly trend is also down at this point in time. So we know our ups from downs let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, we know that Tuesday's breakdown was certainly validated with strong intraday outflows, advanced decline line in trend lower zone, and a brutal cumulative tick down below over here. But if we look at what the rest of the week did, is this confirming or denying the more bearish bias that we've come up with? I would argue confirming. You can look at volume flows. They ended the week extremely neutral with a very minor bearish edge at negative 140 million. Remember that substantial reads are positive or negative 500 million. And if you look at the advanced decline line, sure, it opens in positive territory, but for the most part, fading and fading here on the Friday session as well. If you look at the cumulative builds, they're extremely lackluster and flat on the 3 remaining days after the Tuesday breakdown, but it goes one step further than that. Remember that Thursday is the big counter trend move. That was the quote squeeze that we saw in the upward direction. Were volume flows substantial on that move higher? The answer is no. I would not classify that as new money buying. The advanced decline line had to work its way from 0 up towards trend higher zone, but never actually made it up into that area. And if you look at the cumulative build, remember that the tick will never lie. What is this indication here with the fade? It's an indication that this is nothing more than short squeeze, and it wasn't really sustained buying into the close of the session at the exchange level. Sure, this perked up in the upward direction, but it did not actually build to a new higher high into the close. So overall, new money buyers are not seemingly getting active here. We had a little bit of a short squeeze, and the bears maintain a slight edge. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Once again, let's talk about the failure from the new money buyers, or quote, we should say new money buyers, on the Friday session because they were just simply not there. Remember what took place with value area and points of control on the Tuesday session as well as the Wednesday session, right? This was overlapping but slightly down. Thursday, when the short squeeze takes place, value is finally breakaway to the upside. Point of control is also to the upside. So opening on a gap above value area, which is built out here. Once again, this is, or seemingly, buyers who are initiating because prices were definitively higher. These shorts are feeling pain. These shorts who initiated on Tuesday are feeling pain, and we're back to almost even with the Monday value area and point of control. So it speaks to, once again, if new money buyers were going to enter this market, we should have taken out all of the shorts from down here, and we should have seen value build out higher instead of overlapping to down, because unfortunately that is what took place on the Friday session, right? This is totally overlapping to down with maybe somewhat of a slightly higher high, but a more meaningful lower low on the bottom of value area low. Also, point of control moves in the downward direction. The other thing to point out here is that we finally had a decent excess low at the bottom of Wednesday's move. Thursday had a decent excess low, and now we have a poor high and a poor low, both in need of repair. And considering the close, and once again the failure of the buyers up here on the gap up from Friday, I would tend to be inclined that we would repair the poor low first. So if we interact with Friday's low of day, which is around 43.10, that would seemingly open up the door for a test of lower prices once again. If we start chopping around inside of Friday's range early on in the week, maybe when we attempt the high of Friday, that would be interesting because it's also a mechanical level with the point of control from Monday. So both areas could use repair, but overall the market profile story favors much more so the bears at this point in time based on the failure from the buyers to step up on Friday's gap up. So jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that the XLE for the energy sector was up 1.48%. At the bottom of the barrel, it's the XLU, which is classically D for defensive, down a whopping 6.34%. And as we know, once again, D for defensive, but big shout out to Will A down below in the comments section who pointed out that utilities are probably getting a rotation out of the sector as a whole because short-term yields are far more attractive, right? And really, we saw the outperformance. Let me just pull up the utilities chart first, actually. We saw the outperformance ahead of the updated SEP from Jerome Powell in the FOMC press conference, right? So people were getting bearish and defensive posture inside of the sectors ahead of that meeting. Now that we're seeing dramatic underperformance from the S&P, that would mean that all of the people who were positioning over here are likely flocking out of utilities into shorter term yields because it's, quote, number one, risk-free. And as of right now, the yield is just far more attractive anyways in terms of net percentage points. So even though this would seemingly be an indication that, hey, the defensives are underperforming, it's actually just, money rotation into safer assets at this point in time, which speaks to, number one, you could look at it through a bearish lens, or number two, view, you could just look at it through a volatility lens. And either way, it's really not helpful for the broad market overall to see this sort of dynamic. Let's take a look at, and by the way, just to give you a number, right, anything that sustains underneath 6140, bears in control of the volatility elevation, is still very much so in play, right? Let's take a look at the other structural charts, though. We'll be fairly quick here. Energy, maybe a little bit of a double top in this area here. You've got to get underneath that neckline at 90. That would sustain some bearish pressure for the market, but it's a lighter weight sector and it's also not growth oriented, so not as concerned there. Materials, also a lighter weight sector, sort of sideways down here with the potential for an hourly inverted head and shoulders. No hold of the neckline though over 79, so a little bit more bearish, just getting consolidation on the lows over here, not helpful for the broad market. XLY, certainly a big threat here with a weekly lower high underneath the neckline of what could be construed as a bigger double top, right? Certainly look at the Friday gap up, failed, closed the gap. So as of right now, certainly doesn't look, I mean, it was not a gap and go. And if anything, any further consolidation underneath 163.25 keeps this on the bear side of the market. If we could get a higher low above, it's back to neutral. It's certainly not bullish until we're up and over 170.25. Look at the chart and be objective here. Does this look like a high probability outcome? I would tend to argue no. If we look at XLC, this one's still hanging on by a thread. This is one of the comments that we made in the Wednesday update video. We're in the midpoint. If you want to break this into thirds, number 1, 2, and 3, we're in the midpoint of our thirds, and this still remains a little bit more neutral. If a risk on revival look is going to emerge, it's likely going to come from communications first. Friday's bar doesn't really look all that attractive, with something like a daily lower high potentially brewing on the back test of your daily 50 SMA. Industrials, not much to write home about over here. Bearish consolidation on the lows for a flag. Under 101 gets a little bit more bloody. Let's take a look at utilities. We already did. Let's take a look at XLP for consumer staples. This is also D for defensive, and it also fell off of a cliff. The only difference is that there was no dramatic outperformance early on before the FOMC. So not as concerned about this, but if anything, once again, downward pressure is just downward pressure for the market. Bearish engulfer on the Friday session would speak to bearish odds for continuation of consolidation down here and a real lack, because remember, the open was here. If there was going to be a squeeze through this thin structure, it could have happened on Friday's session. It simply did not. So bearish consolidation on the lows is not helpful to the bull case in our market. Let's take a look at financials. Also a little bit of impending doom, so to speak, here with the back test of your weekly now. Double top, right? Remember that this, as an ascending triangle, wanted to hang on to this breakout part. It did once, and now that we're underneath that, now that we're underneath the double top neckline, financials are certainly not helpful for these sort of attempt, if you even want to call it that, at a reversal to the bull side of the market. Once again, all of the data points that we've looked at so far probably side with a bearish edge, even though seasonality would tend to suggest this is a good time for markets. We would really have to see material improvement, and that's not the material sector, obviously. XLV for healthcare, what's going on here? Threatening the 129 breakdown. Remember that when we break to new lower lows in defensive sectors, that's where we become much more concerned. So, sure, it's fine when it's drifting lower because it's not outperforming, but breaking to a new lower low leaves a lot to be desired because there's thin structure till we get to 126.25. Remember, this is the second heaviest weighted sector by market cap. That would be an ugly breakdown. As long as we're underneath 130.25, bears have the edge here. If we're above, a little bit more neutral. I'll give it the benefit of the doubt. Maybe still a weekly lower high underneath 132.65. Real estate, obviously very rate sensitive. Big breakdown of the overhead range. Not surprised at all here. Really lightweight sector. And last but certainly not least, the XLK for the heaviest weight risk on sector, the tech sector. I mean, undoubtedly, we've got high, lower high, and that's on the weekly, right? Low, and now a lower low, nail in the coffin produced on Wednesday's session. Sure, you're getting a little bit of more price acceptance over the hammer high from Wednesday, but is there not an opportunity for a daily lower high here, especially after a failed gap and go? Also finding an upper wick, producing a daily inverted hammer. All it's going to take is a slip back down underneath 163.25, and this has some work to do in terms of repairing this low, putting a decent excess low in around the lows of Wednesday and Thursday. That's closer to 160.75. If we take that out, there's continued room to fall. Look left, really thin structure into 157.75. Nothing about the sectors currently would be overly suggestive that there's a massive turnaround coming up ahead. Sector ratio grid, if you're not familiar with how to set this one up, check out the video tutorial in the top right-hand corner. For the most part, I think that this neutralizes some of the bearish tone that we've had thus far. In the XLK, notice that we're just putting in a compression pattern here with a lower high, but the opportunity for a higher low. If we can recapture the daily 50 SMA and spend some more time threatening that resistance trend line, maybe that speaks to the resurgence of bullish odds, but as of right now, much more so neutral than anything else. The fact that it's not making a lower low with our broad market is a little bit, again, more neutral than the bearish tone that we've had in some other places of analysis thus far. XLV also rolling over, remembering that this is D for defensive. That certainly wouldn't suggest any sort of posture that is risk off. Financials struggling a little bit, as we saw on the structural chart, and XLY actually outperforming a little bit into the end of the week here. So certainly on that retest, getting a little bit of a boost on the ratio, but structurally still has some work to do. So please don't misunderstand the analysis of the ratios. It's not bullish, but maybe it's a little bit more neutral than what we were saying on the structural charts themselves. XLC still looks great, grinding in the upward direction over here, and the risk off sectors, given the caveat that we discussed with the rotation into potentially bonds, the quote-unquote risk-free asset, they still, again, just in a holistic view of the S&P in sort of a vacuum, would not suggest any sort of bearish posturing as of right now. So overall, this keeps us a little bit more neutral. And we can see very similar things if we take a look at some of the very specialized ratios like tech versus utilities. I mean, obviously with the utilities breakdown, this is going to make a move in the upward direction. It did not break to a new higher high. So once again, do not misinterpret this segment of the analysis. This is not bullish, but it's certainly not as bearish as just looking at the structural charts, keeping us on an even keel here. Similar comments over here with the XLY over the XLP. This did not even make an equal low. It's got a higher low after a higher high. I mean, if anything, that would keep us a little bit more optimistic as opposed to overly pessimistic. So still looking for, I would say what this would align with, if I had to sum it up, it would align with looking for a monthly higher low at the back test of the monthly inverted head and shoulders neckline breakout, but not looking for an Armageddon type sell to turn the monthly time frame chart into some sort of double top breaking down underneath the neckline. Putting our bearish hat back on, the dollar continues to be a headwind, consolidating outside of this as an overall range, continuing to put downward pressure on equities here. Even if this does pull back, I think that it offers a potentially higher, lower high overall in the daily trend sequence for our S&P equities. Let's take a look at the gold contract because this is just absolutely getting obliterated here, falling off of a cliff underneath that 1915 area into the end of the week. Once again, that would support a higher dollar. And even beyond that, silver, we looked at this on Wednesday, right? We finally got the breakdown of this level here at 2280, and that of course would once again leave the door open for some further upside in the dollar, putting downward pressure on equities as a whole. Let's take a look at the 10-year interest rate. What's going on with this? It broke to a brand new higher high on Thursday session. From a technical perspective, this is a very strong uptrend breaking out of a previous high over here, and there's certainly room to pull back for a higher low without jeopardizing the short-term trend. So overall, this continues to put downward pressure on the tech cohort as a whole, breaking specifically to those new higher highs. Let's take a look at the inverted ZT. What would this tell us about the odds for another rate hike? They're actually slowing down and keeping us more neutral if we can fade underneath this level right here, but remain above this level right here. Breaking to a new higher high would imply some sort of additional rate hike, and right now the tracker tool is certainly not suggestive of that. So higher odds for a pause in November and higher odds for a pause in December and even higher odds for a pause over here in January should not come as a surprise based on what we just saw in the inverted ZT. But it goes further than that. If we take a look at the probabilities tab, you can see over here in our higher for longer column, great, it is continuing to be higher for longer, but the total probabilities, if you recall from previous episodes, we were looking at something like 46% odds of a hike in the January timeframe of 2024. That has been substantially reduced to 35% as of right now after the PCE report that we got on the Friday session, which, to be honest, I was a little bit surprised on the initial reaction from the market. The column that we're concerned with is this one right on over here. We were just looking at core as we were in the pre-market live stream, and we saw that it came in at a 0.1%, which was better than the 0.2% as an expectation. And 0.1 on an annualized basis certainly gets us much closer to the Fed's target of 2% inflation. But if you take a look behind the curtain, I mean, look at what's resurging. You have goods reinflation over here, which is really not what we want to see, especially in the non-durable category. That's what people have to buy on a regular basis, and that would speak to everyday inflation coming back into view. And don't even get me started on what's going on with energy. I mean, hide your kids. We're talking about 6.1 on a month over month for energy goods and services. That's absolutely horrific, and you better believe that that has some carryover effect to what's going on with non-durables, right? You're talking about transportation of the goods. That, of course, has a huge role in the ultimate cost to the provider, which ultimately gets passed on to us as consumers. So seeing this report, I was a little surprised about the market's initial reaction to try to gap up on that Friday morning session. It made sense looking at a 0.1, but looking behind the curtain here a little bit, it does actually make sense that the market sold off a little bit on what was, again, after the headline news. If you take a look behind the curtain, really not great of a PCE inflation report. And again, the Fed has mentioned in there, specifically Jerome Powell, in his press conference that, hey, we're willing to look through, again, that's a direct quote, we'll look through energy volatility and inflation reads. But I mean, this is really not what we want to see. Remember that goods inflation came down fairly aggressively. It was the services inflation that we needed to start seeing coming down. So services, finally, we made some progress, but goods went right back in the opposite direction. So no good from that perspective. And I think that that's really going to put the Fed in a hard place. Speaking of Fed, what do we have in the coming weeks worth of trade? Some manufacturing PMIs. Powell will be speaking on Monday at 11 a.m. Keep your wits about you for that one. Harker as well. And then it's all about jobs into the later half of this week, primarily unemployment claims and then the hourly earnings, NFP, and unemployment rate on the Friday session at 8:30. We will be live together here on the channel for our pre-market prep. I hope to see you there on Friday session. Again, coffee and donuts for everybody who comes out to the penthouse. Let's get back to the charts. TLT ratioed to our S&P is continuing to dwindle in terms of the strength of the downtrend, but it is still definitively underneath our resistance trendline. So we can't really say that there's a flight to safety from this perspective, although the utilities rotation might speak to that flight to safety in a non-direct and obvious way, like the TLT ratio to the S&P. So let's take a look at some longer dated bonds in relationship to shorter dated bonds. And what you can clearly see is that ever since we got the updated SEP, these things have shot up like a rocket ship. And that, of course, does not speak to solid risk appetite for equities down below. This makes much more sense and is more correlated with the sell-off that we've seen over the past little bit ever since the FOMC meeting. Let's take a look at some credit spreads, and these are finally starting to play nicely both in the upward direction. Although the longer dated ones have not made a new higher high above this, ever since the end of the week they have been moving in the upward direction, which once again would speak to reduced risk appetite for equities, or what you would say is government-backed versus private corporate grade bonds, right? So overall, short-term did make a higher high. That's your SHY versus HYG, IEF, LQD, getting there. So finally coming into a little bit of alignment. Remember, it was fairly weak on the lows, a bit divergent. Now it's playing nicely, and once again, speaking to not great risk appetite down below. If we take a look at the HYG in isolation, we have to bring this back out to a yearly time frame chart to really see the point I'm trying to make. This is not about direct numbers, but look at where we're trading in the HYG, much closer to the bottom of this as an overall range. If that's going to correlate to this as an overall range, again, the number, we're not looking for precision as in like 3,800, but what we're talking about is a directional vector. Of course, it would make more sense that if these are going to trade in lockstep, equities should come down in pricing here, with the HYG threatening a break through the bottom of its overall trend range. What about the digital gold? What's going on with Bitcoin? Certainly nothing impressive, nothing to write home about. Another flat week. Market breadth, new highs versus lows in the negative territory to be expected on a pullback in our market of this magnitude. SPX A200R underneath the 50% mark, once again to be expected with a pullback of this magnitude. SPX A50R, lower lows, again to be expected with a pullback of this magnitude. Makes total sense. It is not divergent from the price action that we've been getting. The RSP equal weight S&P 500 is finding some support around the 140, the bottom end of this range, and once again that would imply a move closer to the GFR over here in the S&P equities weighted down below. What about the Dow divergence? Another bit of a comment here outside of the scope of divergences, but I mean, clearly this is starting to come back into sync with one another. However, think about the lost year that industrials just faced, the Dow Jones Industrial, right? One of the bigger benchmarks that investors sort of track, maybe not so much anymore, but this was a lost year and this was a failed breakout. If this is a failed breakout and this is a balance range, what would that imply? If you've been around the channel for any period of time, you know that a look above and fail technically implies the bottom end of the range as a target. That means more pain to come over in industrials, and speaking for the broad market, certainly a massive headwind. VIX volatility pulled back into the end of the week. However, you'll notice that we're starting to find a little bit of a higher low over the 15 handle, and this would align with the idea that utilities and the massive breakdown over there, the risk off rotation from utilities over to bonds, potentially the credit spreads moving in the wrong direction that we just saw, volatility remaining elevated during a credit event makes total sense. And so far, this chart is aligned with that as a primary primary thesis as long as we're above the 15 handle in the VIX itself. What about the VVIX? The volatility of the volatility index did pull back off of that 103. The big question here is, do we find ourselves a higher low and do we break over the 103? If we do, that's always the precursor that we're bound to see before VIX really goes for a run up towards maybe a capitulation type bottom handle, which is 40 over on the VIX, right? What about volatility futures for all of our purists? This is also in alignment with more volatility as opposed to less. Look at the move closer to backwardation to sharply fall off to then resurge a little bit into the end of the week. Comfortably, we look something like this. Volatility is just in decay on the longer end of the curve, right? And as of right now, this volatility in volatility that we're seeing once again speaks to the turmoil in the S&P and equities as a whole that we've been seeing throughout this breakdown. So overall, this would not speak to an easy road of recovery until we start gently trending in the lower direction and preventing more of this volatile type look. Even this has moved slightly back down towards the zero line, but it's elevated and once again potentially threatening a higher low. One-day VIX also remaining elevated. Moving along to the QQQ monthly time frame chart, what do we see here from a candle structure and location point of view? Very similar to our S&P, but one glaring difference. See if you can get it before I point it out. Overall, solid red-bodied bar, a little bit of a lower wick. Nothing to read into from a psychological perspective. Great week close from our sellers. Bar to bar, yes, we do indeed have a lower high and a lower low, but where does the monthly bar close? The S&P closes underneath the bottoming tail of the previous monthly range, and this time in the QQQ we find ourselves closing inside of the bottoming tail from the prior hammer. So not as bearish as what we saw over in the S&P. Overall, if we think about the monthly trend, is there not an opportunity for a higher low pullback somewhere way down around 320? I would argue that the answer is yes. Remember that we have incredibly thin structure through the AI mania breakout, so if the monthly time frame chart is going to see further downside continuation, there's the possibility for support here around 320. If it takes a couple of months to get there, wouldn't that be interesting if we also have the monthly 50 SMA? It would be concerning testing that 50 SMA off of a monthly potential lower high as of right now. We'll be more concerned, just like the S&P, about the possibility of a double top if we start trading around this area here around 265. But once again, into October, does this seem like a high probability outcome? I would tend to argue no. The market can always do what it wants to do, but probably 90-10 odds for something that looks like that. Let's take out the Fibonacci's and come in from the sickness low. If we could get a click, thank you Thinkorswim, to the high of the move, still well above our 38.2, and lo and behold, that 38.2 is confluence with right around that 320 monthly higher low for the retest of something that starts to look like a very sloppy monthly inverted head and shoulders, right? Let's take a move on down to the weekly time frame chart and see what we can see from over here. So on the weekly time frame chart, we get ourselves a green indecisive doji, unlike what we saw over on the S&P, where we closed red on the week underneath the weekly open. So a little bit more indecisiveness, quite simply put, out of the NASDAQ side of things. We did technically break to a new lower low, and technically, yes, we did break underneath the neckline of this as a double top, but once again, where did we close? As compared to the S&P, which is well underneath the neckline of the double top, the QQQ is closed basically right on or even above the neckline of the double top. So not as bearish on the higher time frames over here. That would be extremely interesting to me if the QQQ had the opportunity for a look below and fail. I mean, it's very, very minor, but if that's a look below and fail, if we start getting pure price acceptance over, somewhere around that 355, we'll see it on the daily time frame chart in just a moment, we start doing something like this, I mean, the intended target would have to be the top of the range over time. We're not talking about this week. We're not talking about next week. We're talking about over time. And I suppose that might just align with the seasonality sort of thesis. What else can we point out from the weekly time frame perspective? Once again, if we do get a further breakdown, if immediately in the upcoming week we reverse back down underneath that neckline, which don't get me wrong, with a lower high already on the table, with a break to a lower low, we are technically in a downtrend here. I'm not trying to say that this is the most bullish chart I've ever seen, but let's not also ignore this, right? Certainly an opportunity for bull flag consolidation up here. Monthly time frame chart is bullish. It would really require taking out last week's low to rotate through this thin structure to get the monthly higher low retest, which is closer, as we know, towards that 320 area. As of right now, with the indecisiveness, I would keep an open mind on the higher time frames of our NASDAQ. Let's take a look through the lens of our QQQ anchored VWAPs. Still underneath both of these anchored VWAPs, you get your AI mania and then the top from over here. So that'll continue to act as a headwind if we do rotate in the upward direction. First test is still the bottom of the double inside bar, which is overhead. As of right now, that's closer towards 370. Once again, we'll see that on the daily time frame chart. Lower targets, let's take a look through the lens of some Fibonacci's. From here to here, we've still got that 350 area. 350 aligned with our prior anchored view app from over here. It's something to once again keep an open mind to. It's almost, not quite, but close enough for the market. It's close enough here that this low of last week could have been the test of this area of confluence. Just as a general reminder, we still have the massive confluence. If we bring out all three Fibonacci perspectives, there's your 38.2 confluence. And if we come from the low of the AI mania to the top, there's your 61.8 confluence. So close enough for market standards. If it holds here, once again, I'd be very open to the idea of a potential look below and fail on our higher timeframes. What about the volume profile here on the QQQ side of things? We are in the low volume void. Again, the high volume node is much more so a rejection from the upper wick of last week. So if anything, it's a bit more of a bearish data point. We're not all the way in the sort of depths of the low volume void, if you will. But if we do break down, once again, you can see that this is extremely thin structure, not only from literally a candle perspective, but a volume perspective would suggest that that 320 pullback on the monthly time frame chart is a very logical target at this point in time. The Q's daily time frame chart is certainly projecting a bearish expected move for the week, with a lower high being suggested underneath 366.50 or some sort of lower low being produced underneath or around 350, the even number. If we think about daily trend, it's certainly down, with high, lower high producing a double top. We've broken down through the neckline and of course produced a brand new lower low on the Wednesday move in the early afternoon session. Let's talk about the failure of the gap, right? Overall, we did gap up on Friday. We attempted to move into the previous gap over here, and the buyers were unable to close that thin structure, leaving some of that gap remaining. So that's sort of bullish failure number one. Bullish failure number two is the fact that we went for a gap close, obviously underneath us, and there was no gap fill reversal. Instead, we closed inside of the Thursday range. However, unlike the S&P, there's a little bit of relative strength here, just based on the fact that we did not close underneath the breakout point from the Thursday squeeze. That number in the QQQ would be 357. If we're going to find a daily or weekly lower high, it wants to be anywhere underneath 370, right? And right now, that's confluence of resistance with your daily 50 SMA, and it keeps the downtrend well and good. We could even go in for a gap fill reversal, and that could also produce some sort of daily or weekly lower high. Even this 367 level, the low of the Tuesday session ahead of the Wednesday FOMC breakdown, could produce a lower high. So there's nothing about the daily chart that would suggest an imminent trend reversal to a daily uptrend, and obviously we know that we still have room for the weekly lower high. If we're thinking about downside targets, you clearly want to break down underneath this 357 and then get underneath 352. There's a little bit of a line in the sand at 346.85, but underneath that, things really open up. That's the thin structure from the AI Mania breakout. If I scrunch this up, I mean, look way left over here, there's not a lot of market structure, but 346.85 is special because if we take a look at the alternate set with the trend lines here, let me auto zoom this for us. What we'll point out is that that level is basically confluence with the breakdown of the counter trend channel. We're already underneath the major trend channel from the, in this case, January low over on the QQQ. You can see a clear breakdown over here, and potentially this Friday gap up is a lower high on the retest of that trend line. But if we're going to break down from a Man Ray pattern, which is what we've coined this here at Trade Brigade, right? There's your little double top at the high of the head of the Head and Shoulders. If we're going to break down through that, you've got to battle through that 346 level, and then the measured move from the Head and Shoulders, the Man Ray pattern as we call it, brings us all the way down to 320. And what else do we know about 320? That's the weekly or even monthly level that we're looking, well, really monthly. Weekly support, but monthly potential higher low from a trend perspective is a measured move from the top of the Man Ray to the neckline of the Man Ray. Notice the difference between what we have here and the Head and Shoulders in the S&P. You have a descending neckline here, so that's consistently going to be moving lower through time, suggesting that we could technically be spending time underneath this prior weekly low from a horizontal perspective, but have not broken down through the neckline just yet. It's very nuanced, but something to be thinking about here. Let's take a look at the anchored view app set from the bottom, and what you'll notice is very similar to our S&P. There's the AI Mania breakout cohort, and here is the stronger cohort down below. This is all the major pivots from the October low, right? So overall, if we do start to break down through that neckline, you have immediate support coming from the very top of this bottom band, and lo and behold, once again, whereas the bottom of the band, it's confluence with 320 at this point in time. Let's take a look at the hourly time frame chart. I think that the path here is extremely straightforward out of the QQQ, with the minor minor bit of relative strength that we talked about on the weekly time frame chart, on the daily time frame chart. We want to be open to the possibility for neutrality in here. If we tell ourselves the story of buyers and sellers, it becomes quite clear. Sure, we gapped up and sure, we did fail on the Friday move higher, but remember that buyers who potentially got involved on this afternoon flag from Thursday's squeeze, they're still okay. They're not technically underwater until we break down underneath 357. So neutral until proven otherwise in this range. Buyers get a second go for the gap close and maybe the upper bound of this week's expected move only on some sort of higher low. You could start to think of this as potentially an inverted head and shoulders in the making. Your neckline would be 361.50. Once again, we talked about the gap close and the lower high potentially here at 367, but you have to balance this out, right? So if we're thinking about hourly trend, you certainly have lows, higher lows, maybe higher lows. This is a higher high, of course, in the entire sequence. So that's still good, and this stays on the table here. But what happens if we break this? We actually bring in a lower low, and you could start to make the argument that maybe this is something like a 15-minute head and shoulders, right? So underneath that 357, once again, opens the door for downside. We're talking about 352. Then anything beyond that is closer to that magic number from the Man Ray pattern, the trend line analysis we just did, around 346.85. Last but certainly not least, we'll throw some anchored VWAPs on this to see if it's making a little bit more sense, less sense. And what we'll notice, if we could get that to stick, what's going on over here? Oh, we want the intraday. There we go. That's why. What you'll notice is, once again, a little bit of relative strength with the anchored VWAP stacked at 357 as support, whereas the S&P is underneath the entirety of its anchored VWAP band. Let's take a brief look at some market internals for the NASDAQ side of things. You can see, once again, we have a brutal day on Tuesday. Everything else is fairly lackluster, not getting impressive readings from a breadth perspective. We get fade, impressive day on Tuesday. We did get a little bit more meaningful buying activity out of the cumulative tick on the Thursday rally. So once again, remember in the S&P analysis, we said that we didn't make a new higher high in the cumulative build. We actually did over on the NASDAQ side of things. So if you're looking for longs, it would seemingly seem that the NASDAQ is the place to go. There's a bit more relative strength over here. Let's take a brief glance at something like the SMH for our semiconductors, and we'll just go on over to a daily time frame chart here. Let's just reset this a little bit. Thanks for bearing with me. Let's go SMH, and we'll take a look. And what you'll notice on this one is that the neckline has technically been recaptured on the Friday gap up. We're over that 143.40. So if you're looking for a more bullish counter trend trade to continue, I would keep an eye on the SMH, and I would say, okay, if this is above, that would be supporting evidence for our QQQ to make more of that rotation in the upward direction to remain really the more favored long instead of our S&P 500. We could also look at the QQQE for the equal weight NASDAQ 100. And what you'll see over here is, once again, there's your neckline. We also have a recapture, not only in the semis, but an equal weight version of the NASDAQ 100 over here. I would not suggest trying to trade this. FYI, the volume is incredibly thin, but as a depiction, I think it does a great job of illustrating, once again, a little bit of relative strength from that perspective. Last but certainly not least, let me go back on over here. I know this is not the screen we want, but this is. Let's take a look at the NASDAQ through the lens of market profile. We do have a decent excess high. Value area did shift lower, but overall in relationship to the Thursday session, it is actually higher, unlike what we saw in the S&P. So once again, a little bit of relative strength. Also, your point of control mildly higher. Nothing to write home about, but mildly higher. The one thing I don't like is that we do have a poor low at the breaking point of a double distribution from the Thursday afternoon consolidation, right? So I think that the level here is extremely obvious. In the QQQ, it's 357. In your NASDAQ 100 futures, you're looking at 14,810. IWM monthly time frame chart. What do we see here from a candle structure and location point of view? Very bearish, with a move continuing to stay really depressed in this as an overall monthly range. Obviously solid red bodied bar, lower high and lower low on the bar to bar count, and also a failure to hold up over our monthly 50 SMA. Remember that this was the first monthly close outside of this as a balance range, and that has turned into a failed break. So is it unreasonable to think that we could rotate to the bottom end of the range? Absolutely not, which would imply further downside for the broad market as a whole. This is seemingly looking more and more, month and month that pass, like a bear flag. Let's take a look through the lens of some Fibonacci's and see what we can see from the bottom of the sickness up to the all-time high. And what you'll notice is that we again failed the breakout here. We failed to get back up and over our 38.2. The Qs and the S&P are both trading above the 38.2 at this point in time. That, of course, is not a bullish indication for small caps. If we take a look from this perspective, once again, there's your 38.2. What does that classify this as? nothing more than healthy bear flag consolidation. Let's take a look at, let's go to a weekly time frame chart, and then what we'll look at is the volume profile in just a second on a bit of a zoomed out chart. Overall weekly structure, obviously bearish, breaking down from this as a weekly head and shoulders. Expected move would just be the bottom of this as an overall weekly range. You'll notice that the bar structure itself is bearish as well. It's got a green body, but look at the longer upper wick, definitively telling us that sellers were willing to sell once again in the sort of midpoint of the momentum breakdown bar. We did not hold on to the weekly 50 SMA, weekly 200 SMA. All very bearish indications here out of small caps. And if small caps are not participating, it's going to be very difficult for the broad market to really see any sort of stronger turnaround. Let's take a look at the weekly IWM anchored view apps. One thing to point out here, this you're not even going to be able to see where this is coming from unless I do something like this. This is the C19 low over here. That's your anchored view app. We're now officially underneath that over in the IWM and small caps. We're well underneath the all-time high anchored view app and even our October low anchored view app. So nothing about this is feeling comfortable for the bulls at this point in time. Let's take a look at our volume profile from the weekly point of view. And what we'll notice is that this is a major high volume node. We're actually sitting on the point of control if we're looking at 3 years worth of price action. However, that's not necessarily a bullish indication here because it begs the question, if we do ultimately see a breakdown of this range, what's going to happen? All of this is going to turn into overhead supply. Sell, 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 putting downward pressure on the market as a whole. I'm not trying to be a fear monger. Once again, we're not threatening a break yet of the extreme bottom of this as an overall range, but seeing all the failed indications from the monthly and even some other weekly time frame sort of perspectives is not a warm and fuzzy feeling for our broad market here, specifically on the small cap side of things. Even if we zoom this out, let's just give ourselves a reminder of like 10 years. This is really going to skew things, but just bear with me. This is the low volume void. What's the next major support underneath us? I mean, a breakdown of that 170 gets you closer to what? 150s. And it might not seem like a lot out of small caps, but it just continues to then offer up the opportunity for a lower high, even if we bounce there, furthering the pain that the potential broad market as a whole could experience. So higher timeframes out of small caps, certainly not helpful to any bullish narrative that's trying to take form as of right now. Let's go to the IWM daily timeframe chart. Expected move here remains bearish. If this is like a daily head and shoulders, certainly underneath the neckline there with a lower high at 180.66 and a lower low being projected at 172.78. There's really not much structure underneath us that would prevent us from rotating all the way here. It's just one candle if we start breaking down underneath that area in here at 174.75. So again, the daily chart really speaks for itself. There's nothing bullish about it at this point in time. There's no attempt to close the gap overhead, so very similar to the QQQ from that perspective, right? If you look at the overhead gap here, we didn't close that as we gapped into it on the Friday session. We did not really hold this cleanly, the breakout point from the Thursday session. I guess we're right on it at 176.65. That's your major level to watch out of small caps. If nothing else, have 176.65. Let's take a look at the hourly time frame chart. Maybe you could make the loose argument for an inverted Man Ray pattern that looks like this. Inverted head and shoulders, call it whatever you want to call it. But nonetheless, maybe there's the opportunity for a higher low, but it's not really going to change any of the higher time frame perspectives that we just walked through until the IWM or small caps get some sort of price acceptance back above roughly 182.40. I mean, this is where the bulls finally start to get a little bit of confidence going. And again, nothing about the analysis we've performed thus far would be overly suggestive of that. Something like 90-10 odds to remain inside of this lower bound and not breach this into the end of this week. And market can always do whatever it wants to do, but probabilities would not side with the bulls over here on the IWM side. Let's take a look at the anchored view apps from an intraday break perspective. We are underneath the entirety of the band, but once again, maybe we would call that just not so firmly resolved. Willing to keep an open mind over 176.65 for a counter trend move, but once again, nothing changes if we're under this area. If we start to slip 176.65, looking for lower 174.75, and then your daily level we were just looking at 172. Let's take a look at the Russell internals. Nothing about this is overly impressive on the bull side. Neutral volume readings, advanced decliners that fall away from trend higher zone. Tuesday's breakdown is validated. Same thing with the cumulative tick, and even more so a bearish move on the Friday session as compared to what we saw over on something like the S&P S&P or NASDAQ side. The Thursday, in terms of the counter trend move, did produce an equal high out of the cumulative tick, so maybe a little bit more balanced down underneath us, but once again, just as a pivot point, extremely clear out of the Russell. In terms of futures, if you're interested in futures, it's 1800 roughly. Let's take a look through the lens of market profile, and then we'll move into the core list of companies. I mean, look at the value area on Friday. Look at the point of control on Friday, smack on the lows of the overall session, decent excess high at the top, repaired the poor high, came back into the range. It didn't really hold this area right here in terms of the futures, right around 1804, 1800 even. Just nothing about this is overly impressive on the bull side of the market. Once again, if buyers were going to run away with it, you would think that after finally building value out higher above this previous range down here, this was the buyer's time to shine. Simply didn't happen. We didn't produce a bar-to-bar lower low, so keeping an open mind that maybe we go sideways, but once again, nothing about small caps right now is overly impressive to help the bullish thesis for the broad market. Overall, we're dealing with a more bearish market than a bullish one. If you've made it to this point in the video, I want some feedback down below in the comments section. Would you prefer that I go over the QQQ immediately after the S&P and save all of the supporting evidence for after the full broad market breakdown, or do you like it the way it is currently? Let me know down below in the comments section, and let's get started here with Apple for the first up in the core list of companies. This, as a balance range, has broken down, and we have navigated all the way to the target, the forecast basically, of doubling the balance range breakdown. As we talked about in the pre-market prep on Friday's session, as long as we remain underneath the bottom of that balance at 174, the bears have an advantage here with overhead supply weighing on price action, furthering the odds for a downtrend to continue. If we take a look at the hourly time frame chart, we are getting a little bit of higher consolidation above the afternoon from Thursday, so neutral in here. If we do break over 172.50, still looking for a daily lower high to be set at 174. I would be fishing for shorts around this area if we see some sort of setup. If we break down underneath these equal lows, I mean, looking left, we don't have much structure from Thursday's move higher. I would be willing to take a break to close the remainder of the gap down towards 167. Let's move along towards Netflix. Not much to write home about over here. This is still an hourly time frame chart. It continues to be a really ugly one. Let's not spend too much time on it. The big inflection points, if we can get over 384.75, maybe a counter trend move looking for 397.25. If we continue to chop around down here, not as interested in the price action, not trying to fish for new money shorts. Here's the daily chart, right? You're basically fishing for shorts at your daily 200 SMA after a very aggressive breakdown with no counter trend move mixed in there. Not really wise from a risk reward perspective. Here's Tesla, daily time frame chart. Some consolidation outside of the previous range from back down over here, but you can see we're tangled up with our daily 50 SMA, and we still technically could produce a daily lower high, something that looks like this anywhere underneath 260.65. So not getting a lot of information from Friday's bar other than these prices were apparently too low and we are auctioning higher to try to find some newer sellers. Let's take a look over here. On the hourly chart, it becomes quite clear that maybe, right, if this is going to be your inverted head and shoulders, remaining above that neckline is bullish or at least positive for a counter trend, offering up some sort of higher low. So over 247, open-minded, looking for higher, but really, I mean, could this just not be your hourly lower high here on the back test of this breakdown, right? This is the origin of the breakdown. 255 could have been your lower high. So I would be very open to the idea also that if 247 breaks down, we just resume the major trend, which on the daily chart is down at this point in time. Next up, we've got Google. Again, this is an hourly time frame chart. We have not flipped back yet. This is interesting because once again, if this is going to offer a head and shoulders, your neckline is now a trend line, and you'd have to get, clearly over 133.65. There is the opportunity for a higher low over here, but if anything, again, put yourself in the shoes of the buyers from the Thursday afternoon session to see this gap up, or at least opening above, and even in the morning session supporting above 132.25. You're feeling pretty good. Most of those short-term buyers have likely stopped out on the move underneath that area. So I think we have a void of buyers here. And if we break down underneath this area at 130.35, we're looking for the continuation of the, once again, major trend that we were just discussing. Very similar to Tesla almost. Underneath 130.35 opens the door through some of this thin structure closer to 127.25. Here it is on the daily time frame chart. Some relative strength just based on location, still sort of near the upper range of what it's been trading recently. But again, daily lower high possible, absolutely, on the full gap closure from this area back on over here. If this breaks, just looking for the equal low, and that would also make sense from a range perspective over here, 127.25 as that target. Once again, here's the metaverse, Zuckerberg's fantasy land. I mean, daily chart is unbelievably sloppy. We're continuing to talk about this in the pre-market preps. Trade this one at your own peril. No comments. I would say that the major levels would just be, call it 300 even, 306, 310.75, and 294. Again, trade at your own caution. Look at the volatility here. Look at the volatility back down over here. Just a lack of respect for technical structure at this point in time, at least. So very open-minded to leaving this one on the back burner. Not thrilled about the price. Let's take a look at NVIDIA. NVIDIA actually did break up and over that 432. So the ideal lower high on the hourly time frame chart would have been right here, kind of where we struggled into the Thursday afternoon session. We did make a higher high above, so open to the idea that this could hold. But if the broad market is falling off of a cliff, I would be looking for the breakdown here. And this would still be, if we go to a daily time frame chart, just a very, very obvious lower high. You have highs, lower highs, potentially daily lower highs underneath the backtest of this now, closer to 445. So not really flipping to the bull side over on NVIDIA. You have a daily inverted hammer breaking down underneath 432, opens the door for back lower towards 419.25. Here's Microsoft on a daily time frame chart. Similar concept, right? If this is a backtest level based on this, right, breaking down over here, potential for a daily lower high, and we're still sitting at that inflection point at 315 because prior to this we had a 3-day balance range. Here it is on the daily time frame chart. Here it is on the hourly time frame chart. This is your 3-day balance basically. As long as we're over that 315, it would be very difficult for me to want to be overly aggressive on the short side. You would want to see a failure back down into the range, target the bottom, then a breakdown after setting some sort of daily lower high at this 319.75. If we continue to consolidate above, I would look for this. That starts to change the daily trend just a little bit. The backtest is not as obvious for the lower high at 319.75. The next level overhead, 326.75. Last but certainly not least, the mini beast. What's going on with Amazon? Then 4 trade ideas for you. Again, all of these levels are very, very in play early on in the week. There's the possibility that this is your hourly lower high. I like that as a possibility, considering, once again, here's your daily time frame chart. We made a higher high, and then we made immediately a lower low. So that's usually an indication that any sort of rally attempt that you get can be met with a lower high, and then you look for continuation in the downward direction. To see a higher high and then immediately a lower low all in one fell swoop, the buyers didn't even, there's no attempt, right, at a higher low, right? So seeing that, once again, would suggest that overall the sellers are in the driver's seat here. So if this is a lower high attempt on the back test of this 2-day range, looking for lower underneath 126.25, trade your downside targets 124, then we have 120.50. For buyers to really be in control, you would have to see some sort of higher low above that gets you neutral through here, then maybe the gap close is your overhead long if the broad market as a whole is moving in the upward direction. 4 trade ideas, and then you are on your way. Did you leave some feedback down below? Come on, do me a favor. Leave some feedback down below based on our prior question. Do you like the current sequence, or should we change it up and save the supporting evidence for after we've gone through the entirety of the broad market? What's going on with RIVN, ticker RIVN? Potential for a double bottom over here as we approach the neckline. That level is 24.30. Not a lot of range. I would probably just trade the stock outright. If we do see a break, looking at this as a potential target, 27.65. This is primarily in play as long as a pullback here can hold up over 23.20. Remember that we have come for a 100% retracement of this as a breakdown. It wouldn't be unreasonable to consolidate first before looking for some sort of breakout. Again, the ideal pullback wants to keep it above 23.20. Next up on the chopping block is going to be KO for Coca-Cola. Warren Buffett. What's going on with him? The Oracle of Omaha. 3-day balance range closer to the lows, but more importantly, you can see on the daily that we're certainly sold, right? No doubt about it. We're sitting on a lower low. If we take a look at the hourly time frame chart with a little bit more nuance, notice that on Friday, it takes a careful eye to catch this, but we did actually break to a lower low outside of a 2-day balance range. So question, why was it that the sellers were unable to accelerate as the broad market as a whole was kind of selling off in its entirety? We actually closed back inside of the range, so not only is it look below and fail, but if the daily is actually oversold and we have thin structure to retrace, a move up and over this 56.25 opens the door for a counter trend move to potentially set a daily lower high closer to 57.45. This trade idea is only on the table if the broad market is moving in the upward direction. Next up, we've got Roblox. RBLX is the ticker over here. Let's first go to a daily time frame chart. A lot of these are sort of bottom fishing plays, if you will, if the broad market's going to continue. Notice that this is a lower low double bottom, so less confidence than what we just saw over on Rivian, but nonetheless, your neckline is very well defined at 29.50. If we break, we have thin structure to retrace. 32.50 becomes the target, and then there's even a gap overhead, but one step at a time. Let's not get overly trigger happy here. If we're going to consolidate, the ideal pullback wants to keep it above this consolidation. Now let's move down to the hour. hourly, right? So above this consolidation here at 28.25, ideally, this produces a look like this. On the hourly, you might even just consider a cup and handle, right? Consolidation here, and then a break on the daily time frame chart for that upper target. Not as interested if the pullback is deeper than 28.25. Next up, we're going to take a look at WMT. This is a bearish trade. I know the previous we're looking for bottom fishing, but this is a bearish trade. If the broad market starts falling apart, we have ourselves a daily support trend line. We have ourselves a horizontal level, and on Friday's session, we actually produced a bearish engulf where we open on the gap up, we completely engulf Thursday's range and Wednesday's range. We break underneath our daily 50 SMA, and we're at this confluence of super support. So if this breaks down, you get a nasty rotation, at least on the daily, there's the potential, right, for a move into 153.50. That's not a day trade, but over time, the course of a couple of days, the primary outlook on the loss of 160 basically is in the downward direction. If we scrunch this chart out, you'll also recall that 153.50 is a major weekly or even monthly level at this point in time from what you can see over here. That's going to wrap it up for today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section. I know it was a long one with those monthly time frame charts mixed in, but I do appreciate you coming out to the show. I really hope that the analysis is changing the way that you see the markets, changing the way that you trade, and hopefully leading to a more profitable outcome. With that said, have a green trading week, and I will see you in the pre-market prep.